Hello and welcome to our Yardi Matrix Multifamily National Outlook on April 15th, 2021. My name is Megan Furr, your producer for today's program. We are joined today by our hosts Jeff Adler and Jack Kern. Our program will run about an hour and we hope you can stay with us for the entire broadcast. We want this to be an interactive conversation, so please feel free to submit questions in the Q&A icon at the bottom of your screen, and we will try to respond to your messages while covering relevant topics. If we don't get to you, please contact us afterward for a more detailed answer. A recording of this broadcast and accompanying slides will be available after the program. Please note that what we discuss today may or may not be relevant to your situation. Please read the disclaimer carefully and consult your tax and investment advisors before making any decisions. Now, I am pleased to welcome Jack Kern, Director of Research and Publications, and Jeff Adler, Vice President of Yardi Matrix, to our program today.
Hi, thank you, Megan, and thank you all for spending a little time with us, and I hope we'll make it a good use of your time, as always. So I'm going to take myself off of video so you can focus on not me, but with the material at hand. So anyway, what we're going to cover today is just a kind of an overall view of, first, how does the economy look like? What are the employment trends? Just to get a sense and get grounded and discuss also the trajectory of interest rates. We'll go into multifamily fundamentals and where that's shaking out across the country. Discussion with the tech hubs and major international gateway cities. And then we're also going to kind of follow up with some interesting work that we've done on the future of work and try to assess the extent of the impact of that for multifamily, and also to describe a new segment that we've begun to analyze around single family build to rent, particularly that subsegment. So as we kind of get into things here, first of all, here's what we said in November, right? We said there was migration, rent and occupancy had fallen, but there was a movement of people. We didn't expect valuations in gateway cities to go down much. We expected valuations in tech hubs to come up, and it's kind of happened. We kind of said things looked like they were holding up fairly well, but there were some points of pain, and that we expected the gateway markets to eventually recover and tech hubs to expand, and that was our thought process in November as we were kind of 8-9 months into the pandemic. Now we're coming out of this, and now as we look at things now, you can see the economy is heating up as the job market strengthens, really as a result of progress in the identification of vaccinations, the approval of those, and now we're into the deployment of those. And so that's really what's driving this. The economy is moving forward. A concern that we'll have to kind of watch for is inflation. We're seeing it in asset prices. We're beginning to see it in input prices, but we'll discuss a little bit more about that. There's been a general spreading of the population. And so we've been discussing this question over the next several months about what's temporary, what's permanent, and also what is the nature and the future of work, because a lot of the employment base in multifamily, particularly at the upper end, is sort of office using employment driven, and that has a big impact on where things are going, and we'll discuss that. We've seen clearly the gateway markets and the urban cores have turned a corner. They're still swimming upstream. They've got a long way to go, but clearly a bottom has formed and there is a recovery happening, okay? And the tech hubs continue to do extremely well, in the suburban areas of those tech hubs even better than the urban areas. So in addition, one of the sort of knock-on effects has been a kind of turbocharging of demand for single family rentals, which has created then a need for single family build to rent, almost as I say, horizontal multifamily, which has really kicked into multiple gears. It was already there before. It's another one of these kind of COVID accelerators, and we're covering that sector and that segment, and we'll discuss it in more detail. So the other thing I do want to mention before we get kind of too deep into sort of this is there's a whole series of issues that were pre-COVID that are still there, and that will return to these, but they're all bubbling under the surface and are beginning to pop up. Things like, basically, there's still an affordability issue. There's still a rent control issue. There's still, and I would say, heightened political risk in certain places. There's an introduction of environmental risk into our entire framework of infrastructure and political risk, which we've been working on. We'll incorporate that, I think, in the fall. We've discussed infrastructure and the ability to handle future growth. We're going to see that, kind of further in evidence as areas do have significant population growth and development of their metropolitan areas. And we still have this notion of key technologies, which are a constraint on inflation and the ability for a wage and price spiral to really take off. We'll all get back to that, so I don't want to ignore those topics, but clearly we just don't have the time to cover them all. And I'm happy in the question area for us to sort of like come back to those as relevant. So the first thing to note is, a recovery in GDP is clearly underway. The Q1 numbers from the Atlanta GDP at 6%. It's clearly things are moving, and I would liken this to a shot out of a cannon. If you look at, again, I always mention Ed Hyman. He's a great guy at Evercore. And you look at his perspective on things is you look at 2021, real GDP 8 to 9%, 10-year bond yield at 2. It's at 1.6 now, 1.5 now. Unemployment rate down from 6 to 4. And then 2022 is really at the end of 2022, we are back to, I'll call it, trend line. And that really is a notion of why is this happening? There is a lot of money sloshing around. There's reopening of the vaccinations. There's economic momentum and things that were already building from pre-COVID that have sort of, again, been kind of turbocharged as cash has been moved around because a lot of purchasing power wasn't destroyed. There is a lot of money in sloshing around in just checking accounts and savings accounts. There's $9 trillion, 6%, $6 trillion over what the normal run rate would be. There is a lot of money sloshing around. So again, we kind of think this is a shot out of a cannon. And
Jeff,
you can see this.
Not surprisingly, a lot of people on the call have sent in questions in advance asking, so when is this going to end? How much better is it going to, how much better is it going to get? So it's something I know that we need to be talking about as part of.
Yeah. So, I mean, I think the issue we kind of have is we're in, I would say, for the next, let's call this 18 months, kind of a recovery from the destruction that occurred in a year ago. All right. So really getting back to trend line, where our trend line was, kind of 2.5% growth at 2% inflation. So I think what the really issue is what happens once we get back to trend. Okay. What are the sort of, I'll call it, downstream effects of what was done to get to trend? Okay. And are there any overreaches that are happening and any pressures that are building? And that's what we'll kind of get to is, but for the next, again, the next 18 months, you're going to see, quite a bit of a shot out of a cannon. Economic growth is going to be great. There's going to be a lot of rent growth, a lot of money to be made if you're in the right places. And so that would just say is, yes, it tails down back in 2023. But again, if you're talking about the speed of recovery, remember we had a whole bunch of questions a year ago about, is this going to be a U? Is it going to be an L? Is it ever going to come back, right? So that uncertainty has kind of been taken off the table. We kind of understand where we are from here back to trend. And if you get to look at the financial markets, right, the stock market has clearly recovered because, again, a lot of cheap money, a lot of money sloshing around. A lot of it has flowed back into the stock market. The 10-year is 1.6, 1.7. I think today it's at 1.5. There's a short squeeze going on. We do expect it to kind of go back to a 2.5, maybe even 3% trend over this period of time. Even today, if you look at the 10-year yields on a relative basis, we are, in the land of the blind, the one-eyed man is king, right? So we're still continuing to attract capital into the United States because of our relatively high interest rates and a positively sloped yield curve. What this means for you guys and the team here is that we're probably going to have the foot on the short end of the yield curve through the end of 2022. So if you're going to do something that's floating rate or LIBOR based, You probably are okay for the next 18 months or so before short-term rates start to move. Long-term rates will start to move, and again, a steepening of the yield curve is a clear harbinger of profitable lending opportunities and an acceleration of growth, which we do expect to see. So the longer concern, and we'll get to the inflation, which is the longer concern, okay? Which, as I mentioned a year ago or 6 months ago, that was the concern I had for the next 4 to 5 years out, and we'll return to that. Again, one of the things we've seen is just a shifting of purchasing power, purchasing from services into goods, and that's been kind of the story over the last year. Those production problems are pushing up the rates of goods, which was, remember, we had goods deflation for a ridiculous number of years and services inflation. The script has been flipped. We are beginning to see it go the other way around, right? Now that services are starting to open up, you're going to start seeing inflation where capacity was vastly reduced. Airlines, car rentals, where you'll see a shot in prices because capacity was cut back so much and will have to be readjusted. Hotels really didn't you're not going to see a shot in hotel rates so much, except in certain, certainly in business centers, but in certain tourist locations as those locations open up. So if you kind of look at this in terms of change in monthly retail sales, right? You still have, this is February 21 to 20, you still have the sort of the homebound effect and the clothing and food service down. Again, I think those will start to see that script flip back up. Oil prices are in the 60s. I think this morning's at 63. It's been bouncing around 60s. It's kind of right now in its sweet spot where U.S. oil producers can become the swing producers. You've seen OPEC open up production. So around 60, it's not really an inflationary pressure in my mind yet. We're probably not going to go back down to 40 or down to the depths of 11 or negative. We were there for a little bit. But neither do I think we're at $100. So at the 60 level, it's probably, that kind of 1 to 2% kind of inflation area. This is, man, if you kind of go back, one thing we had discussed for years was services inflation, goods deflation. And now this has been the script has been flipped. I do think it will come back and readjust over the course of the next year and a half. But if you look at implied consumer inflation, I'm going to focus the word on consumer inflation as opposed to asset inflation. Consumer inflation, this is the 10-year, the spread between the treasury and the tips is 2 points, not out of hand. And asking rents, have continued to expand faster than the CPI overall. You'll see a little bit of a dip in the urban areas, but not, again, if you look at a national level, rents continue to grow at a national level faster than inflation. Consumer expectations of inflation are higher, right? We saw, I think the March number for CPI was 2.5, and consumer expectations are north of 3. That's probably not that unusual because, again, the CPI measures a basket of goods, some of which people aren't buying. So consumer inflation expectations will tend to be a tad higher than actual, just because the things that you buy are the things that are increasing in pricing. Again, not out of line in my mind. And the real issue, and I'll go back to this for a second, the real issue is we're going to see, with base effects, we're going to see a spike in reported inflation probably over the next 3 to 6 months. There's a base effect impact because prices were down quite a bit in the second quarter of last year, not a surprise. And there are sort of production bottlenecks in certain goods producing industries over the next few months, which won't get sorted out again for the next, again, in the fall. You'll have a reopening of services and there'll be a pop off the bottom. So again, I think for the next 6 months, we'll see a bit of a bulge in inflation, but then I think it begins to come back down. Okay, the only fly in the ointment here is if there is a kickoff of a wage increase spiral that then gets transmitted back into pricing. Okay, so again, it's not the issue that over the next 6 months you really need to worry about. It's by the fall, do we see inflationary pressures begin to wane and competitive pressures and deflationary pressures take over? to get us into the Goldilocks of 2.5% inflation. If we're there, then interest rates are still like negative. At least the T-bill versus interest rate spread is kind of negative, and sort of mortgage rates will be mildly positive on a real basis. Still very conducive to profitability when you look at rents are nominally adjusted, right, every year. So still the investment case is still there. The unemployment and underemployment is falling. It's still elevated. I do expect this to kind of come down, as we've kind of mentioned before. So I'm not awfully surprised. You've seen a decline in attachment rates to labor force participation. Again, I think that will begin to unwind. Hawaii, California, New York still have the highest unemployment rates. But again, I think those will begin to lessen as vaccinations continue to make progress. It's just that they're going to be laggards from a state perspective. If you look at this data is only through July, and I think you would further see amplification of the existing trends. Texas, Florida, the Carolinas, Georgia, up. Again, you look at the entire Mountain West from Arizona, Idaho, and probably the New York and Chicago and Illinois are more negative than this chart would indicate. But again, broadly, around those pre-existing migration corridors. And again, if you look at the labor market recovery, it's absolutely been K-shaped. If you look at the bachelor's degree or higher, right, in terms of unemployment, pretty much flat. In fact, there are labor shortages popping up among highly skilled tech workers, where below that, employment's still kind of 10% below, off of the bottom, but still sticky 10%. And if you look at wage rates, again, the people who have been at the bottom end of the scale have been hurt the most. Things are beginning to open up. You can take a look at these vaccination curves. The issue with J&J is unfortunate, but it probably only pushes things out 2 months at most. So overall, if you look at the trend line, I'm not all that worried. I do look at what's going on in Israel as it relates to how quickly they're opening back up and in what way. The UK has also been fairly successful. AstraZeneca, again, might slow them down a little bit, but the bottom line is the trend line is quite positive. When we look at activity levels, it's transit that has just not come back, where mobility for driving and walking kind of is above it, and again, that will be an urban core slow kind of recovery. And we won't spend a lot of time on this. We don't have a lot of time on this to spend, but I did this in 2017. I'm doing it now, which is any kind of fiscal policy is always a basket of things, some elements that are pro-growth, some elements that are anti-growth. I do believe that it's generally a return to the 40-year prior consensus of favoring urban and suburban consumers. However, our China policy is still a little bit ambiguous as to what exactly that is. The tariffs haven't come off. They're still there. So it's ambiguous. On the pro-growth side, interest rates are low. There's a lot of liquidity. The vaccinations are ramping up. There is the potential for inflation there already is asset inflation. For goods inflation, is offset by an aging population that is saving and deflationary technology. So that is and also a global supply chain. So that mitigates some of those inflationary pressures. Anti-growth, some executive orders on energy, finance, and tech, a very difficult inability to open schools driven by the public sector unions, where they are particularly strong in coincident gateway cities, and a whole pile of ambiguous stuff thrown in the middle that hasn't fully vetted itself out, given the nature of our politics. So when you kind of look through that, and then we have where's this $2 trillion that just got approved? Where's the money going? Well, there is some, a fair amount of money going to folks who are on unemployment, and that will kind of mitigate any employment loss. There's a lot of money sloshing around. The $350 for state and local governments. It's hard to argue that was really needed, given the fact that state and local tax receipts weren't all that off. and the school support for those that haven't opened. There's a lot of pork in here. There's no way around it. The housing assistance money that's already been approved, that's $50 billion of housing assistance, is very slow to get out. We do have a little plug for Yardi here. We have a program that is available and being deployed to those governmental agencies to help them get the money out with some level of accountability. But it is a slog. So it's hard to, and if there's another infrastructure bill that's kind of on the take here, there's again more slosh running around. I'll kind of go forward. So what do I see? We're in a recovery. It's a shot out of the cannon. Employment's coming, GDP's coming back. Employment is following. We're going to be watching, kind of consumer inflation rates and rising long-term rates, but still not really out of it, and how much of the migration flows out and comes back in a gateway city. So it's pretty good. And again, I can discuss something issues on collections. There is a little bit of a problem out there. It is more concentrated. It's probably about 6% of receipts in some of these other areas. This is our market universe. When we look at an investment strategy, we're going to highlight some global gateway cities, some emerging tech hubs, established tech hubs, and there's a little bit of gish here. Is Miami a global gateway city or not? Is Chicago one or not? Is Seattle we only have as a tech hub versus a gateway? You can argue all you want, but this is our definitions. So a big thing to note is just these migration corridors. They were there before. It has really been amplified. And again, if I did it out of Illinois, I would probably down to the Gulf Coast of Florida, which is a existing migration corridor, and into Tennessee as well. So this is a well-established pattern. It's just been accelerated. And if we take a look at absorption, we took a net absorption and as well as kind of rent growth. We can kind of see that in the upper right corner, these are markets that have done very well. Inland Empire, Phoenix, Sacramento. These, what do they have in common? They're tech hubs, or they are sort of like the next city out from a major international gateway. They've done quite well. And the bottom left, you can kind of see low absorption and declining rents there as well. Now, if you look at occupancy and growth rate over the past year, and again, I'm just looking at March year over year versus occupancy change on a year over year basis. You can kind of see again clustered the same kind of tech hubs that have done really well. And again, in the bottom left, Austin would probably be more notion of supply, not at all demand. But you do, again, it's the same kind of pattern of gateway cities kind of getting hurt. And if we look at this at a floor plan level, right, this is just saying that the studios are the ones that got hurt the most, right? Those are the people who could leave most quickly. And again, a bottom has formed. And then we do see this kind of moving up. And if we're going to go further, and take a look at sales volume, it is recovering. It obviously took a dip. People are out, they are bidding, they are trying to get money out. There was a surge. Most of the activity, not surprisingly, has been in the tech hubs, just because those are deals where values have gone up and things will trade. The gateway markets, there's not a lot traded, and there probably won't be a lot traded. If the assets are in trouble, most of the folks can hang on for what they hope will be better times. So you're only having sort of forced sales to occur, or 1031 things or something like that. So we expect this pattern to continue, with reduced amount of gateway market sales, for the next couple of years. When I looked at transacted sales prices, there wasn't a lot of movement on a per square foot basis. And that's something that is a little bit of a surprise that's beginning to diverge. But again, I think we'll kind of see that happening. When we go to supply, these are some areas where you gotta say, all right, as we look at movement of people, which we're seeing, we also have to put in what's the level of supply. And so, it's going to be hard to get rent growth in places where there is a lot of supply coming or already there. Austin is an example of great demand characteristics, but so much supply that it hasn't really been transmitted into rent growth. Boise's, again, has a lot of supply coming. It hadn't had a big supply response. And so we expect some of these markets, as good as they have been, to lag a bit when it comes to to rent growth. But again, there are for the next couple of years so much demand in some of these areas that it will overcome it. But there is a lot of supply coming, and it is concentrated. A lot of the prospective deals are being stacked. But remember, the cost of construction is rising, so some of the rents have to go up for that to make sense.
Jeff?
This is Jack. You had a question?
Yeah, just going back to the supplies.
Yeah.
For a second.
Sure.
I guess there's 2 points. One of which is the distinction of new supply in terms of things like student housing, senior housing relative to market rate, and second, the differentiation between the likely impact on luxury versus renters by necessity.
Yeah. So, well, first of all, we pulled out student housing because we don't do a separate student housing forecast for supply. The amount of senior housing that's in here is quite modest, given that it's age restricted, but we do have it in there. It's quite small. Most of this is Class A because that's the only things that economically make sense. There's still a huge problem about being able to deliver Class B new assets. There was work being done before the pandemic. I suspect that work will get picked up again. A lot of the product is still urban product because it was started. There is a shift now to more of the projects being done in the suburban areas with an attempt to be more Class B. In order to do that, you got to get to the zoning authorities and focus on an affordability where you have to strip out all the bells and whistles. So there's still a problem. If you look at all the metrics, you're going to see that renter by necessity Class B type assets, the rents are growing much faster. That was the trend we saw before the pandemic and is absolutely the trend we see now. Does that make sense, Jack?
It does. And for those of you on the call, we're getting a flood of questions, and we appreciate that. If you'll please stand by at some point, we will be reviewing the questions and be able to help you.
Yeah, so Jack will weave those questions in. This is our take on supply deliveries over the next 5 years. So the bar chart itself is the absolute number of units, and then the percentage number is the average annual increase in stock. And so where the stock is 2-ish%, that's usually within the realm of absorbable. When you have numbers that are over 2, like Miami, like Austin, right, just going down the track here, or like Salt Lake City, there you've got places where it's going to be a little bit of a slog to absorb those. And when you also have gateway markets at 2% and demand has been destroyed, those gateway markets are going to struggle. If we were in a pre-pandemic world, a 2% increase in supply in San Francisco or Chicago wouldn't be too concerning. But in this environment, you're basically piling on, as it were. And when we look at this, we just took a chart here of like, let's take a look at some absorption and some completions, and then which areas, right? So Salt Lake historically has had a gap. We think that may get closed a tad, but you can see that most of these tech hubs have had a lot of absorption relative to completions and are pretty healthy, and that a lot of the urban areas, the international gateway hubs, had been the other way around. Not universally. There are a couple of markets that could be headed for a tad bit of more supply relative to absorption, but it is a generalized kind of topic. And this is our forecasts that we put together in terms of what we expect rent growth to be and occupancy growth to be over the next couple of years. And you can kind of see, I mean, Raleigh is underperforming a tad this month, but it's not out of line for it to be in the 3-ish number. Phoenix is doing probably better right now than we've got forecasted. Boise and Vegas as well. Austin, I think we'll have to kind of pull back, but you see a lower occupancy rate. But this is a pretty healthy kind of view of how we think the market is proceeding. And these rents, again, the pandemic rents didn't go down hardly any. So these are very healthy markets driven by domestic migration. And the other way is the gateway cities. We think that rents are coming back, but they also have a long way to come back. Now there'll be a bounce as concessions are unpeeled and are peeled back. But I think it's still going to be a pretty long road over the next several years for the gateway markets to recover under the best of circumstances, assuming everything else kind of lines up. There has been a fair amount of movement if you talk about the movement of people, the headlines tend to focus on movement of people from one metro area to another, traditionally from gateway to these tech hubs. There also is just as much movement within the metropolitan area, out of the urban core and into surrounding areas within the metropolitan area. And so the suburban areas have done significantly better than the urban areas. And you can see this from some data we got from USPS and San Francisco Chronicle of the extent that people moved. There is a fair amount of movement. They've moved, 30 miles, 40 miles. So those are meaningful amounts of moves that make coming back to the office on a 5-day week basis very problematic, but not detached from the metropolitan area entirely, which is good news there. Now, if you look at the density, this is something, again, look at the last couple months of data points, right? You see at the highest density area, a bit of a hook up, and I think that's important, but you continue to see in the lower density area, rent growth continuing to grow. And I think, again, it's kind of a combination of everything. I think our last month we had 114 of 134 markets were either 0 or positive. Of a top 30, 26 of those were positive. So you've got a lot of forward momentum here that'll carry us for a bit. And you can kind of see here in the urban cores, we just look at the urban versus suburban segmentation, right? Again, the big news here is the sort of hook up in the urban areas and the emergence of a bottom and a recovery, where the suburban areas continue to do well for rent growth and a little bit of a leveling off, in terms of occupancy change. It's not too surprising. This is something I've alluded to before, is the performance of suburban areas outperforming the urban areas, and a movement and spread of the population within an area. Even in a tech hub, the suburban areas within that tech hub have done better than the urban areas, with Colorado Springs and Tulsa being two minor exceptions. You see this in examples here in Long Island and the San Fernando Valley of rent changes over the course of the past year. And this is just in the gateway markets. This is just more of a detail market by market, right? So Manhattan is the starkest one in terms of the occupancy drop. But you can see then a bottom forming and a recovery happening. You see that across Miami, probably one of the more shallower ones. Washington, D.C. also shallow. Boston and shallow. So if you look at among the gateways, D.C. and Boston have performed, I would say, probably the best. And then, as we mentioned back on the political risk several months ago, those two markets were the best positioned among the gateway cities in terms of their overall political climate. And so, again, not altogether surprising. And Miami's a tweener between, is it a gateway city or not? I throw it in there, and it's done reasonably well. But we still have rents, not fully recovered in San Francisco or New York or Chicago. One of the sort of headwinds that the urban cores are going to have to deal with is supply is still coming, right? So there's still a slug of supply through 2023 in the urban areas before it tends to tamp down. I will tell you personally, I think the suburban numbers will start to move up in 2023 based upon the activity I've seen. However, construction financing is not super loose. It is feasible. It is going to good sponsors with good track records, but it's not super loose, and costs of lumber have increased, building materials have increased, and so it's a little hard to get that thing to happen. So again, I think when you look at the urban gateways and the urban cores, you're going to see some headwinds over the next couple of years and a slower recovery. So what do I take away from that on a national level, right? Gateway markets and urban cores were hit the worst. They found a bottom. The population is getting vaccinated. Things are opening. Gateway markets and urban cores will recover, but I think it's a couple of years, 2 to 3 years. The tech hubs are kind of off to the races, something we were talking about pre-pandemic, but it's been amplified. And I think they'll have the most growth this year. And I think they are well set up to gain critical mass to continue to grow of their own on a go-forward basis. So,
Hey, Jeff.
Yes.
This is Megan. We're a little
Yes.
over halfway through,
Yes.
so now might be a good time to ask a couple of attendee questions.
Sure, fire away.
Okay. Do you expect higher tax rates to play a role in migration and future returns?
Okay, so first of all, when we talk about tax rates, I think we have to look at property tax, right? So if you would say, well, gee, the $350 billion that was given to local governments should cover their problem. Why would they have to increase their property taxes, right? And in fact, income taxes haven't gone down much. So you shouldn't see much. Yet, if you look at what's going on in New York State, you'd say, well, why are they raising their taxes again? So to the extent, again, I wrap this into a general notion of political risk. If property taxes in the places that were already expensive go further up, it is another sort of like, headwind. Same thing with income taxes, if they were to go. Now, countervailing that would be if for some reason the Democrats can get through a repeal of the state and local tax limitation, that might mitigate some of the reason for domestic migration, which is going on. But when you look at the New York tax bill, it was going in absolutely the wrong direction. Why would you raise personal income taxes already pretty high to make it even higher, to make coming back to New York even harder? So in my mind, that's where my head would be at. Is I'm not. It's more, I'll call it gasoline on the fire for the trends that are existing. Another question?
Sure. How can one afford to build Class B with construction and land values increasing at such a high rate?
It is a real problem. Let's not kid ourselves, okay? It is a real problem. And it's going to, and if you look at where things are at, both land costs being up, as well as construction costs of all sorts, it's very difficult for that to happen. Remember, there was progress being made. A number of organizations were working really hard to get new Class B built. There was some momentum happening along those ways. I think to the extent that metropolitan governments return to this issue and lean into it, there can be, I'll call it, some incremental progress made, but it is not going to be easy. And as we'll see, part of the notion of Class B value add was to a certain extent because of the need to commute. Now, to the extent that the need to commute is reduced and you can go further out, land costs are cheaper. We'll see this with single family built to rent. The ability to spread the population further will mitigate some of the need for some of these solutions, but they're still there. So the free market will find a solution, either people moving, this is what has the case, or costs coming down. And right now, I don't think we've seen yet the real lean in of local governments really sort of taking this issue up. It was beginning to happen pre-pandemic, but I think it's been put on pause for a year. Any other questions before I move on? I want to be mindful of everyone's time.
Yeah, let's go ahead and then I'll save the rest for the end.
Super. So one of the biggest issues in my mind, probably the biggest issue, as it relates to kind of Class B, B plus, and A multifamily, right? The sort of investment grade sector. Again, I kind of view Class B and above as sort of investment grade a multifamily, is what's the nature of the future of work? It's probably the biggest issue that you really need to sort of like tackle if you want to understand the geographic displacement of people and where it's likely to go and where it would be. And we're going to tackle that kind of head on. As I've mentioned, this is a slide, if you've seen this from the last time, there's a bunch of trends that were already there that have been accelerated. There's been a bunch of trends, there's only 3 trends that have been somewhat reversed. The experience over things, I think, so things have been winning. Physical goods have been winning. There's been investment in physical goods. It'll lean back toward more experience, I do think. But globalization and supply chains has been leaned out. You'll see some leaning back in, and densification is what's kind of taken a hit. It was already de-densifying due to demographic issues, and that, so again, I would say, has accelerated, and I don't know that really kind of comes back. So the majority of those folks, there was a lot of people who moved. A lot of folks were younger. You can see that in the studio numbers where they kind of peeled out and then kind of came back. But again, this is still a significant movement of people. If you look at the share of people living at home, right, it took a pop up and it has been kind of coming down, but it's still somewhat elevated compared to 2019. 18 to 24-year-olds, but about the same in terms of 25 to 29-year-olds. So there is a movement. You see it in the leasing momentum at the studios and one bedrooms. It's starting to come back, and we expected it to peel back at some point. But transit mobility remains quite low, right? So particularly cities that were heavily dense and heavily dependent on transit, it's still down quite a bit, even if driving and walking is up. We take a look at office. This is some great data from Castle in terms of swipes and how much of the offices are open. Texas kind of leads at a third, 40%. It's still not what it was before, but it's better. And then, of course, you've got the gateway cities, extremely low utilization of office space. And this does come into play here. Now, the work from anywhere, okay, has fueled migration all over the place, right? So the big notion of work is not somewhere you go, but something you do is kind of a big thing, right? So most office using employment have seen that from a pure task orientation, all right, they can get their work done, right? So that notion that you have to be in this 5 days a week in an office to get work done has kind of been busted up. What's an appreciation is, however, is that some work needs to get done. Training, bonding is hard to do over Zoom. So that there's like, well, fully remote isn't really going to happen. Fully 5 days a week probably isn't going to be happening. And the timing of the return to offices does vary by market, by vaccinations, by the ability to open up. And really, the more dense public transit will probably happen at a slower pace is what we're seeing. Employees have been taking an opportunity to move out of dense, costly metros to lower cost alternatives. And those with the most, what we're seeing is those with the highest skill level are the ones who are sort of the camping to the furthest out because they have job security, they're scarce, and they're not really looking to move on to the next job. And so they're the ones that are spreading the most. Folks who are junior folks, while they move, they're likely to come back. And so I do want to emphasize as we get into this, if you've got an axe to grind, you're going to find a particular data point that supports your vested interest. So because there is a tremendous amount of movement going on across metropolitan areas, within metropolitan areas. Some companies are going 5 days a week if they have a certain regulatory need. Some have gone fully remote, and a whole lot of people are just somewhere in the middle. So it's very important to parse out this and try to find meaning here. So prior to the pandemic, about 10% of the labor force worked remote all the time. It looks more like 25%, and it's higher for office using employment. You can see the numbers in Indeed kind of went up, doubled from a year ago. Obviously, industries like technology are better equipped to handle remote work than compared to financial activities or governments, which, and I think that again, you can see the corner cases or legal firms who probably need to be together more. So the other thing that's the upside of this is that the shift to remote work is giving smaller cities and communities an opportunity to compete with coastal hubs for residents, to revitalize these what had been a winner-take-all kind of labor market. There is more of a spreading, which is actually at the end of the day good for the country, good for the economy, but there is significant dislocation geographically. So if we take a look at just the national shift in remote work, well, look at this in November. While it's less than it was in May, it's still fairly elevated. And you can see, of course, at the bottom, if you're in food service or construction or transportation, warehousing and retail trade, that's really not a remote kind of thing. But if you look at office using employment industries, right, that is much more. And that has become, in my mind, somewhat sticky. So here's the corner case, right? Financial services, JP Morgan, Goldman Sachs, we're going to be in the office. There's compliance issues. We sort of survived. Remote, but it's not going to happen. It's not going to happen long term, and they've made those commitments to their space. Okay. Other government areas are a little more hybridish, right? Personally, I think there is an opportunity for some government work to be hybrid. There's still a need to serve people face to face, but a lot of the work can be done remotely, or certainly in a hybrid fashion. Now, when we go to tech, this is where the hybridness or fully remoteness really kind of comes in. And this is the sector that have been absorbing the most office space and also was the magnet for employment growth in all tech hub cities as well as national gateway cities. And here you've got kind of a mixture, right? You have some companies who are like Twitter, Square, Microsoft. Yeah, go, don't bother. You also have Google and Amazon kind of leaning the other way. And I would just tell you, our own company, Yardi, is in the middle of this kind of debate itself, where there's sort of like, well, 5 days a week probably isn't going to happen. 0 probably isn't the right mix either. It's probably 2-3 days a week is kind of that mixture of lifestyle, and probably nothing can happen until the schools open. But we're talking kind of what happens after the schools open. What's the long run? In education, K through 12, it's got to be in person. Where we look at the data we're putting together on student housing, which we cover now, the universities are going to be more hybrid-ish. And a whole bunch of new models will be forming. The cost structure of the education system at post-secondary is so high that there's going to be a search for a way of changing that up, but it's still going to be hybrid, and college kids will still want to hang together. So from a housing perspective, I feel pretty good about that sector. If you look at this, the take-up rate, right? There was a lot of ability for a lot of jobs to be done remotely, with the take-up rate pre-pandemic was relatively low, and that take-up rate has definitely kind of popped. So we began running some analysis at a metro area to say, well, what do we assume about this, right? And it's not unreasonable to assume that 20 to 25% of office workers will or can be remote full-time, and that the bulk of office workers will be on some kind of hybrid schedule, and that there'll be about a third of the office workers will, for regulatory purposes or other reasons, have to be full-time, and full-time is probably 4 days a week as opposed to maybe 5 days a week, even then. Okay. And so the real risk is that 20 to 25% of office workers, they could be anywhere, right? And if the only reason that will tie them to the metro area they're in is the search for the next job, not the current job, okay? And that tends to be at I'll call it the individual contributor, but at the senior levels. So then we began to take a look at this and say, okay, well, let's look at office using employment by metro. Let's estimate this impact. Let's look at the renters and try to figure out what's the potential impact on the housing stock by city. And so, you take a look at some of these numbers, and anything over, I call it 18 to 20%, it looks serious, right? So LA, San Francisco, New York seem to be the places that are most potentially impacted by this move. Now, will in-migration of recent college graduates offset this? Partially, but not completely. And so you have other cities that are impacted to a lesser degree, not a trivial amount, but to a lesser degree. And again, probably based upon cost of living, it's less of a concern in some of the tech hubs. It is a meaningful concern in the international gateway cities, particularly LA, San Francisco, New York, and Chicago. We then layered on, well, what happens if you look at the hybrid folks? Now, the hybrid, when I look at the hybrid people, that is probably more a spreading of the population into the suburbs of that metro area, as opposed to leaving it entirely. I don't think that's going to happen. But what that does tell you is a lot more spreading of the population outside of what had been very spiky with urban core, where everything was happening in the urban cores. So if you're a let's say a San Francisco metro area only investor, well, I think a lot's going to happen outside of downtown San Francisco. If you're a national investor, then obviously you're spreading your bets, and that's already happened among all institutional investors, spreading their bets kind of around. And what that does highlight, again, if you look at that, it's not just the office workers, right? It's the 2 to 3 service jobs that were supporting those office workers. Now, the interesting thing to note is that a lot of those people who are in that sector couldn't afford to live downtown in an urban core. They were living in a suburban area and commuting. So their lifestyle actually might be improved because they don't have to commute as much. And the jobs will probably be reformulated in the outlying areas of those metro areas. So we'll focus on this on our commercial webinar on May 13th, even further. But that's, again, one of these silver lining issues that kind of come to the fore. So it's not all bad news, except if you're, kind of heavily invested in that urban core. So this is, and talking to just a tremendous number of occupiers, companies who are actually thinking through this, and what they've said, both informally and informally, what you kind of see here is the average employee of a medium to large business will probably end up spending 2 to 3 days a week in the office. It makes up the majority of the leasing space. It's going to be all the marquee names you're going to hear in the press. And the question is, will there be an increase in square footage per employee? I'm not so sure, but the fact of the matter is you're probably looking at a reduction in the footprint of 10 to 20%. And if also that people are in the office only 2 to 3 days a week, it means all of the associated transit systems, restaurants, parking, all the other sort of services that were built around that probably see a 40% permanent decline in their activity levels. And that is meaningful. Now, an interesting thing in the small companies, less than 20 employees, there's a lot of companies who have just said, I just don't need a space, period. I can cut my costs. Nobody really cares anymore whether I'm in business with a marquee location. And in fact, I'll just use a co-working space if I need it, when I need it. So there may be a bit of a boon for co-working spaces to kind of cover for a lot of this. And I've spoken to owners of small companies who have made, and also small branches of larger companies who've kind of said, I just don't need it, period. So that's another kind of like sculpting of space. So we will return to this in the office sector, but if you're looking at this, you've got to say, okay, there's a meaningful sculpting of office space in the urban cores that will take time for employment to grow back into, again, several years. And so if you're looking at this from a multifamily perspective, what it kind of tells you is that it will take some number of months, some number of years for the urban cores to recover. They are recovering. There will be a bit of a snapback as a bunch of folks who had just moved temporarily, particularly in the studios, kind of come back when the city's open and the lifestyle is there. But there will be new supply. It'll be a bit of a tough slog, is where I conclude. Now, we also did this is a great thing that BBVA did that I'm citing here, is they looked at some sensitivity tables, really looking at from an office usage perspective. And for us in multifamily, it's really where people move relative to where they were, right? So if you look at telecommuting, really sort of work from home, work from anywhere, and employment growth, you still have an impact here of, if you're at the baseline is probably a negative 15 in my mind in terms of space utilization. And I think that is probably the best case. And if you go the other way, you can actually see some things that are even worse. What that does is identify that there are going to be, I think, potential distressed opportunities in the urban core as things kind of move out of the headlines. Right now, the banks and everyone's been very accommodating to kick the can down the road. You also tend to have in these same locations the biggest problems with evictions, the biggest problem with collections. And so not only is the rent and occupancy down, there's also a bigger haircut on rent collection. And so we just looking at our DSCR data and estimating how many properties could be in potential distress, you get a bunch, you get a handful. You see the same thing in San Francisco, not a ton, but they're there. More in Manhattan, again, not a ton, but they're there. In Chicago, so I think this is all going to be based upon the world moves on, the headlines are over, and now 9 months to a year from now, you've got sort of like a reckoning. I think that's where it kind of comes to the fore. So this is a kind of a notion of, we think the tech hubs, as we've said before any of this happened, the tech hubs were positioned to do well due to cost of living, due to migration of companies and functions. It's been accelerated. The tax code that was passed in 2017, 2018 accelerated that. And so we're all seeing that kind of happen. There is a very lively debate as people try to figure out how, from a company, each team within a company, each function within a company, each function within an office within a company, how this all kind of shakes out. But I think generally speaking, we can expect will this mitigate over time? In 5 years from now, will the fear of missing out draw people back into the office? perhaps with a lag. Are there some people who are desperate to get out of their home situation and come back to work 5 days a week? Yes. Okay, but again, if you look at this from a broader perspective, something fundamental has changed, and it won't go back entirely to the way it was, certainly for the number 5 to 7 years, if at all. And I think that's a key thing to note. Now, another knock-on effect that's kind of occurred here, and I know we're running out of time, is what's happened in single-family rentals. That is, again, this was already happening. It's been a shot out of a cannon. The demand is absolutely there. We can look at the rents. There's no question about it. And raw material prices increasing. So where this single family home prices are increasing. And so there really are a couple of different kinds of forms of single family. And I'm focused on the build to rent, right? So the ones that are pre-existing, there's a sector out there, there's a business that runs that. I'm kind of focusing here on where it's got to the point where it's time to build for the purpose of renting single family. And really, the upper left is more the horizontal multifamily, right? Which are either detached or attached single family homes. There are other kind of segments, but I would say the horizontal multifamily is going to be more like the sweet spot. But there is traditional single family, and there is a regional component to that. There's a ton of people chasing this in terms of money that is being put out, and so there's a lot more coming. We actually have now begun to sort of cull that out as a subset, as a subclass within our multifamily data service. It's existing, it's live today. There's about 170 assets in the database today. We have a list of 330 in total that we're still working through. So there's another 100 and a quarter that we still are going to be finding and vetting. It is obviously where land is less expensive. And so that's where you're going to find it, in the Southeast, in Texas, in the Mountain West and in interior California, and in some elements of the Midwest. This is data I had never seen before, where we actually look at rent, year-over-year rent growth for single family build to rent assets separated from the larger notion of multifamily. And these rent growths are kind of pretty amazing. When I chart this as a group, you kind of see it rising gently until about April of 2020, and then it is a rocket, just like a completely different chart. We're also tracking the occupancy by market, and there are concessions in some of these deals. There is lease ups going on. We do track the lease up progress. One of the things that I had kind of wondered about was, well, how does this compare with traditional suburban multifamily? And in most cases, it's really going further out, right, where land is cheaper, so the rent level is not too far off from a 3-bedroom multifamily, but you have to go further out to get it. Okay, so that kind of hangs together, right? So it's more of a lifestyle commuting situation than it is a saving money or spending a whole lot more money. And it varies a little bit by market, but not a ton on a per square foot basis. And so that's kind of where this sector has got a lot of legs to it. As long as down payments for homes stay 10% of values or higher, and values have gone up, so the down pay has gone up, I think this single family built to rent has some significant legs to it. And so I return to the view we had before. The economy is heating up. The pandemic has spread people out. We've had something to say about the recovery of gateway markets and the future of work and what that means, and what that does for both distress opportunities as well as single family built to rent, which we are covering. Some upcoming events. I'm going to be on the mashed potato circuit a little bit more. I expect maybe to be in person come June and July. Let's knock on wood on that one. And I thank you. We'll have time to take more questions, and the lawyers make me do this thing for the copyright notice and the disclaimer. Sorry about that, but you know how the lawyers are. So with that, I am going to go back and open this up for questions. I appreciate everyone's time. I've tried to be cognizant of it, but I'm happy to stick around and answer some more questions. So Megan, Jack, hit me up.
Megan, go ahead.
Sure. If modern monetary theory is formally adopted by the Fed and fiscal spending becomes the dominant macroeconomic lever driving economic growth, what impact does this change have on long-term rates and, more importantly, exit cap rates in 10 years?
So this is a fundamental question about how much money is sloshed out, and what's the nature of inflation, right? And there's just a lot of cross currents here. The United States has the benefit of being a reserve currency for as long as it is a store of value, and there is not really an alternative reserve currency that is tradable. The euro isn't quite it. It's got very low growth. Nobody believes in the yuan, so by default we are the reserve currency. Okay, it gives us enormous benefits. There is a, I'm constantly studying things like Ray Dalio's views on big debt crises, as well as instances of hyperinflation that have occurred in Hungary, in Germany, in Venezuela, in Zimbabwe. We're not at that stage yet. On the other hand, the only real reason that we can finance this debt is because interest rates are so low. And if we were really smart, we'd go 100-year debt. But in order to maintain the appearance of fiscal balance, our debt's short term, where it really should be long term, but it's short term. And so we can finance this level of debt. It has been concerning to me, particularly once you get above 100% of GDP, which we are at and beyond, which we're projected to be beyond. The cautionary tale of Japan hangs out there. It has an aging population. It's got 225% debt to GDP. It tried to inflate its way out of its problem in the 90s and has not really ever fully recovered. On the other hand, we are a far more dynamic economy. Our population growth is slowing, but it's still positive. We have the ability, if we opened up to legal immigration, to juice that population growth further. And we have shifted our basis of our economy around technology, which is inherently deflationary. So I think, the real issue is what you spend the money on. Does it return an investment, or is it merely wasted? We're on the precipice, right? Right now, it's a little bit hard to say which way this is going to cut. Certainly, the proposals out of the administration don't give one a tremendous amount of comfort that an infrastructure bill will actually create infrastructure. And because if you did spend money on infrastructure, both digital infrastructure and physical infrastructure, that could have significant societal benefits. So I guess what I'm saying is it's a bit of a jump ball at this point. There's a lot of cross currents here. I haven't yet come down definitively on this. I am watching this really closely, and I always hate to kind of say, well, we'll see, because I think that's kind of milquetoasty. I would lean at the moment towards, landing in a place where you could live with 2.5% inflation, with an aging population, and not blow us up. But that really is based upon a set of fiscal policies that are still a bit undecided. So Megan, I don't mean to be evasive, but that's about as definitive as I can get.
Sure, thank you.
Sure.
Next question, if COVID has proven that work from home is more widely successful than earlier thought, should we expect conversion of downtown and suburban office space to multifamily?
It's being attempted, but it ain't easy, okay? Particularly, and so let's say, I'll give you an example in New York City, where they're trying to take office space and convert it to subsidized housing or affordable housing. It's hard to do. So I know there's even some attempts to turn some hotels into multifamily. Again, hard to do. I don't think the land cost in the suburbs, that's probably more of a scrape and build as opposed to a conversion if it's suburban office. And they are creating a community around an office versus hotel, shopping, and multifamily in the malls, because that's already was sort of underway. I think it's just hard. It's hard to make the numbers work. Let's put it that way. But there is interest in doing so. There is some money being put aside and some funds. It's just you got to get the assets at such distressed levels for it to work. But there is work attempting to be done on this.
Sure. Since the gap between the change in the housing price index and the change in owner's equivalent rent is back to housing bubble highs, will elevated housing prices impact the demand for multifamily properties?
Well, I think it's the elevated price of single family homes is juicing up the demand for single family built to rent. Okay. And um, if you look at the inventory of homes, it has declined dramatically because the people who have a home are saying, I don't know if I really want to sell it, and where would I go if I got one, right? Because I have to replace it with something. So inventories are low, which then is giving a boon to new supply, and we need something like 1.2 million or so housing units to hit to equivalence, and we still have there's I think 2 or 3 million units deficit built up. So there's a shortage of housing in the places people want to live, which is juicing up demand, and the craziness of having um, sales prices above asking, all right, is now quite commonplace, which is kind of nuts. But it is not associated with a debt bubble, right? Normally, when you look for, I always look for places where people are sort of over levered. Well, they're not over levered. Okay, you got to still have a down pay, and there is cash flowing around. But there is movement out of higher, more expensive locations into less expensive locations. So these are funded. That's right. They're funded moves, right? So it is creating a demand for single family built to rent, which we're seeing clearly. The elevated home prices are creating a deterrent to movement out of multifamily and into single family, as long as there's a significant required down pay. But the demand being centered is in tech hubs in the suburbs or urban areas in the suburbs, as opposed to the downtown core, which is, I call it a younger, is designed to be a kind of either right out of college or post, kind of post family raising event where it's the life. And also, I would tell you that it presumes a level of public safety to enable people to access that.
Great, thank you. Is the mass exodus from city story overblown, and how permanent do you think the moves that did occur are?
Yeah, well, there's always look. The fact of the matter is something happened, right? And so it's not like I can say nothing happened here, because it did. I've always kind of said that I expect about half of the number of people. Again, let's separate this out. People who owned homes or owned condos, you had about 6 years worth of demographic moves compressed, right? So that it pulled forward moves that we were thinking were going to happen anyway. It just pulled it forward. So you got a hole to come out of. Again, I'd say about half the folks who moved out who were renters, they will come back because they want to live in a vibrant city, and as long as the city opens, it'll be fun to be there, fun to meet people, fun to do things, and so those cities clearly have a future. There is a fair number, again, I'd say about half of those folks have said, hey, you know what? There's a vibrant downtown in Austin. There's a vibrant downtown in Raleigh or Charlotte or Atlanta. It's nice to be in some of these gateway cities, but it's a lot cheaper, and I had a pretty decent life here too. So not all of it'll come back. So that's what I'm saying. There's somewhat of a permanent or longer hole that has to be slowly filled back by university students who graduate and do come into the major cities, and you have new supply. So you're swimming upstream. Again, it's not, you can't count a global gateway city out forever, and I would not count that out. But I do think there's a hole that will take some number of years to fill back, to the extent that people who have apartment buildings and they do not have the capital structure to ride out 3 years of difficult financial times, those will be distressed candidates. And if you look at delinquencies or accumulated delinquencies, and I'll call it effective vacancy, it is also highly concentrated in those core cities where the political environment is less benign.
Great. What do you see as the largest secular headwind to future investments in multifamily, and what is the largest tailwind?
I'll go to the tailwind. The tailwind, the demographics are really good, and the movement of people is really good. So I think there's a lot of tailwinds. Headwinds, I'm kind of racket. The only thing you'd say would be a headwind is if you have a dramatic change in the notion of property rights, right? And if people who squat suddenly obtain property rights, and so you can't monetize your investment in multifamily, and that would be a bit of a disaster. Okay. There's going to be discussions about the tax code and 1031s and capital gains taxes, and those things are impacted, but not the end of the world. But the notion, and this is, I want to emphasize this is a societal choice. If you go to Germany, all right, German multifamily is a utility. They get about 2% rent growth, and that's it. The whole notion of value add isn't there. That's why a lot of German capital is in the United States. So we have a societal agreement or understanding that there are benefits to society by having a vibrant, professionally managed rental industry that creates supply, creates choices for consumers. And the other side of that is that those property rights have to be protected, right? So if you don't pay, you can't stay. Well, if you don't pay and you can stay, and that becomes a societal norm, not the exception, then that's a whole different story. So that the cultural issue or the societal framework of what constitutes, capitalism versus socialism, more broadly speaking, is probably the biggest threat to the multifamily industry.
Okay, and then I'll ask one more question.
Sure.
Since we're approaching at 15 minutes over,
Sure.
But anyone who we didn't have a chance to ask your question, please feel free to reach out to us after.
Sure.
But the final question, there was a movement of seniors moving to the urban core. Do you think that movement will return and partially mitigate the hybrid workforce?
Partially. And here I want to emphasize the importance of the public safety framework. That is a vulnerable population from a safety standpoint. To the extent that the public safety consensus about what constitutes a good city is reformulated, then that would probably be quite a significant, I would have saving grace, right? Because there's the need for suburban housing, and people who are kind of post-child rearing would be a great, and the population is aging. That would be a great, movement back into the city core. So I think that is likely to occur, but the city cores that they move into may be different than what had been assumed in the past. I could say, Miami Beach, Atlanta, Austin are great urban cores and are great retiree locations. So I'm cautious about it. I think yes, it will help some, but there's still some headwinds here.
Awesome, thank you.
Hey, before we wrap, Megan, I just want to thank everyone for joining us, for being a part of this dialogue, for asking amazingly wonderful questions. If there's something that you really want to talk to me about, you can always email me, and I'll try to set up a time to chat with you and share whatever knowledge I can, if I can be helpful at all. I really appreciate the loyalty of the Yardi Matrix customer base and the Yardi Systems customer base. And I just want to thank you for the opportunity to do this. And I hope it was a good use of your time. I hope you enjoyed it. And I'll always, and of course, copy the slides and the recording we posted probably sometime tomorrow. So Megan, if you could wrap us up.
Yes, absolutely. Thank you everyone for participating in our program today. We hope you enjoyed it and found the information and viewpoints helpful. If you would like to subscribe to any of our free research, please either log on to yardimatrix.com or contact us and we will add you to our distribution. A recording of this broadcast and accompanying slides will be available after the program. A special thanks to Jeff Adler and Jack Kern for their commentary today. I would also like to thank Jeff Muth and Mary Chu for running the web program, and Maddie Harper and Claire Anholt for their contributions to the content. This has been a production of the Matrix Division of Yardi Systems, Inc., copyright 2021, all rights reserved. This concludes our broadcast. Thank you.